But back to Robert Shiller. This is the impact of inflation on price-earnings multiples. Turns out in almost every market you look at, there's an inverse relationship. High inflation rates equals low price-earnings multiples, low inflation rates equals high price-earnings multiples. Not obvious as to why that would be. For those of you who like to think about the dividend discount model for equities, inflation is actually in the numerator and the denominator, but let's not worry about that for tonight. There is this relationship. So if you have a view on whether inflation is likely to rise or fall, you may have an implicit view as to whether you think price-earnings multiples will rise or fall. And here's a forecast derived simply from the Shiller PE. Notice again, if you look at where the orange line is on the right, which needs to be looked across at the left-hand scale, that would also say that returns over the next 10 years from equities might be reasonably healthy, assuming the world stays the way it is, which I'll get to in a minute. Now, all of this is a big challenge for the industry. If you accept the fact that it is simply crazy to have the kind of static asset allocation processes that we have today, it's arguing that asset managers and everybody else involved in the process, consultants and clients, need to change what they're doing today. They need to turn the 80-20 role on its head. Firms which have organized themselves in very specialist silos need to start thinking about multi-asset skills, asset allocation type processes, think of the fund as a whole, think about real-world outcomes, think about delivering a return which is not something over a market index, but is inflation plus 5, for example, something which might actually help pay a pension. It's a big sea change, huge change to the roles for almost everybody out there. Now, in the interest of time, I'm now going to skip over the 7 regulatory sins, and instead I'm going to stick my head out a little bit more in terms of forecasting. But I was always taught that when giving forecasts, you should either give a price or a date, but never both. And at this time, and for the first time, I bring to you something I have resisted doing for 36 years in this industry. For 36 years, I've resisted the temptation to say that this time it's different. But this time it is different. It really is different. And here's why. The engine of economic growth, I put to you, post-World War II, has been the global growth in credit and the US consumer in particular. And I believe that the credit crisis has knocked a very big stake through both of those hearts. We therefore have to think about where global economic growth will come from in the future. And the obvious place to look is towards the emerging world, towards the BRIC countries, for example, and also potentially post-Copenhagen still to climate change. And let me touch on both of those. BRIC consumption today is still only about 40% of the level of consumption in the United States. But growth in BRIC consumption already exceeds growth in US consumption. And I'm not talking about growth in US consumption last year, which was effectively zero, but the more normal 500 billion a year that it was doing in better times. BRIC consumption, growth in consumption today already exceeds that. So that's good news. We have another engine beginning to fire up in another part of the world, and in a part of the world which is not constrained by debt in the way that the developed world is. And climate change, if that process is in fact going on, is going to lead to a requirement for huge expenditures to fuel new technologies to help mankind, if not mitigate the disaster, if Copenhagen has truly failed, but to at least help us to adapt to it as temperatures rise. And when you run the kinds of numbers out there, they are actually significant. They represent something like 1% of GDP, which incrementally, year by year, begins to add up. So there are other alternative sources of growth. But I also want to pick up on this point made earlier this evening about the fact that you can often have a sensible forecast, which is the average of two totally different events. It's rather like, deciding that you're going to have an election in the United States, you're going to get a Republican or a Democrat in the White House. You never get half a Republican or half a Democrat, right? And I think we're at a really challenging point, and there's a really interesting subtext to what's going on with Greece today that we all need to think about. Japan has been running a very large fiscal deficit for a couple of decades now, and has a debt-to-GDP ratio which is eye-wateringly high at around about 200%, and makes Greece look positively modest. And Japan has been able to fund that deficit at near zero rates of interest without any trouble whatsoever. I would put it to you that the reason why Japan has been able to do that is because the Japanese save 25% of their incomes, and we don't over here, and also there's a belief that the statistics in Japan mean something. But there is a lesson coming to us out of Dubai, there's a lesson coming to us out of Greece, and that is this. If the private sector has started a long-term process of deleveraging, which has barely got started, and if the last borrower has stepped up to the plate, the government, if we find that markets discipline governments and don't allow them to continue to borrow, to sustain the kinds of fiscal deficits we have today, even on a declining path over several years, then we are in a very, very ugly situation whatsoever. The economic recovery that we have today could abort very quickly indeed, and we could find ourselves facing another recession with no more ammunition in the policy locker. Interest rates are as low as they can be, and if governments are unable to borrow to spend, we have a true problem. Now, of course, there's a peculiarity, because Greece does not have sovereignty over the central bank, to say the least. And there is a real difference when you look at Greece and the UK. The fiscal deficit in the UK is actually a little bit bigger, probably, than the one in Greece. We start from a lower debt position, but we also still have sovereignty over our central bank. It may be independent, but we have sovereignty over it. And that means that ultimately it takes one act of Parliament to get control back again. And if markets don't let the government borrow, at least we can print it. Not great, but we could pay our teachers and our policemen and our nurses with depreciating pounds, an option which isn't necessarily open to Greece. I was last here in this building about 8 years or so ago at a debate being held here about whether the Czech Republic should move quickly into the euro or take a more measured pace. There were about 10 speakers, as I recall, and I was in a minority of 2, along with one German financial journalist who said that the Czech Republic should take its time. I really still believe that that is the case. I believe it is the case because the structure of the euro, in the absence of, if not political union, fiscal union, is inherently unstable. But secondly, as a succession country, you face a very, very different issue. Success, surely, for the Czech Republic in joining the EU is for wages, real wages in the Czech Republic to converge on EU norms. That means you are going to see major realignments of your economy, and to try and constrain yourselves to live within the same interest rate and inflation discipline as the EU as a whole as you go through that adjustment, and to take it all through liberalizing labor markets and productivities is, in my view, a very difficult challenge indeed. So ignore me, please, but my personal advice would be the structure is already showing signs of potentially terminal strain. You are well out of it today, and who knows, once you've converged on European wage levels and the euro is stabilized, time to take the decision then. I will leave it there in terms of forecasts. If we have time, George, for any questions, I'm happy to take them on this or any other topic other than football, about which I know nothing. Thank you. Please.
I just wanted to ask you if your graph of equity returns from 1683 included reinvestment dividends.
No, it didn't. It's purely capital. And obviously dividends is hugely important over that period. But it does show that remarkable elbow in terms of asset prices as you come out of the 19th century. Yep.